for me, it's been about really tuning into the assets. And assets to me is your own business, owning property, having then your ISAs and pensions invested in the stock market, and just going back to things like multiple streams of income and planning for tomorrow, but also enjoying today.
Good morning, everyone. Chris Selwood here from the Property Success Podcast. I'm delighted to welcome once again, because this is your second time on, Paul McCoubrey from Navigate Independent Financial Advisors. Paul, good morning to you.
Morning, Chris. Thank you.
How's
Yes,
it
it is the second time. I think it was during
Yeah.
COVID we did the last one.
It was, yeah. The years just fly by. Nearly 6 years ago,
Yeah,
early in
6
COVID,
years,
five and a
yeah.
half anyway, and it's just
Around
gone.
Paddy's
blink of
Day.
an eye. Yeah. So Paul, you've been coming to Belfast Property Meet. That's where we met. Belfast Property Meet, for those that maybe have never heard of it, monthly networking event at Windsor Park, the National Stadium at Windsor Park in Belfast, depending on whether you're a Northern Ireland supporter or a Linfield supporter. But anyway, we'll move on. So you've been coming to Belfast Property Meet for a number of years, and on the back of it, obviously a business owner running Navigate, and previously, you had a business before that, and then became a partner in Navigate, maybe 12 years ago, 10, 12 years ago?
11 this year.
11 years ago. And obviously off the back of it. And I think when you come to Property Meet at the beginning, maybe like most people in your position, finance, mortgages, that kind of stuff, financial advice, you were looking to pick up customers. And then I remember you saying something about, I just happened to talk about something, or one of the guest speakers talked about something, and it triggered something in you, and you decided, hang on a second, I maybe need to look at being a property investor myself, even though I think you told me you had no intentions of ever buying property. And there you are, you've started investing in property, running the financial services business alongside. Everything, as I would expect from a financial planner, everything's been very deliberate and particular, and a lot of planning and keeping an eye on a lot of detail. What was it, and maybe I've sort of answered it, but from a personal point of view, what was it that got you started investing in property when you thought that your life was going to be all about just financial planning, mortgages and stuff?
Well, you got me invested in property, obviously, by presenting an opportunity. But going back a few steps, I've been going to Property Meet for 12 years. If you remember how I know the date, because I had to Google it last night, was Brendan Rodgers took over as manager of Liverpool a couple of days after the first meeting, and his brother did the talk. Yeah, I grew up in a property family. My dad was being a property investor during the noughties, and I actually left school within the estate agency, and then that led me going into doing financial services. And that was all when I was 26. But I saw Property Meet as another networking event around Belfast. I obviously was a mortgage broker at the time, and I understood property. But when you said I had no intention of investing in property, I didn't think I could invest in property because I didn't have a 25% deposit. And obviously the rules had changed after the great financial crash. So I just went along, and if you remember, I was always in my suit, and there was another mortgage broker there who was sort of there some weeks and not the other weeks. And I just thought to myself, like, I'll keep going in my suit, which I looked upon at the time as my uniform and looking the part. And I just went along because I knew I would pick up clients. But you and I then formed, I remember saying, can I meet you for coffee? I want to pick your brains. And we met at the Mount, and then obviously we just got on as two lads as such into football, and got on well. And then I just said, I remember you saying to me you had these deals, but you'd been burnt badly in the crash, that you were struggling to find finance. And I just put a comment out to say, look, I don't have any money, but what I do have is a good credit report, and I'm an honest, decent person who obviously has his own business, and etc., etc. So you presented those first two houses in Ballymena, and we met. And if you remember, my dad met us, and we did the deal. And I still have the first agreement that I sent you, which was an email agreement between us saying, right, we're buying these, that's why we're buying them, and we tried to go through what if scenarios. And basically it was left that you and Mary would manage the properties and I would manage the finances, and that's been that. And then from there it grew. When you say deliberate, that makes me laugh because I'm not sure it was completely deliberate. There was mistakes. You fall into things. You buy stuff that maybe we definitely wouldn't buy today. But that's just different times. But when I think back to that, that was all pre the pension rules changing. So up until 2015, when George Osborne announced that you have pension freedoms, you would never have invested in a pension. They were far too restrictive when you got to retirement. So property, your own business and property was really the two most viable ways of building assets and building wealth. And it's just continued from there. And that's obviously being a financial advisor. My dad had bought when I was young, like 18, 19, dad had bought me Rich Dad, Poor Dad. Don't think I read it probably till I'm in my 20s and a bit more mature. But that was always the ethos about buying assets and producing an income, and off you go. Does that answer it? So it wasn't always deliberate, I would must say now with
Yeah.
maturity joining Navigate. Navigate is, well, there's 18 of us in it now, so it's a much
I,
bigger
I, I
business.
think I think when I said deliberate, I kind of meant that, the way that you would analyze things and, being a financial advisor,
Yeah.
numbers had to work and things had to be right. Not necessarily everything had to be right, but there was
Yeah, like a
a
good
sense of
spreadsheet.
being very yes, at spreadsheets and making sure everything was bang on. And funny you say when your dad came along, and I remember thinking, oh shit, he's brought his dad along. This is not going to end well. And his dad's been into property, and I couldn't judge the mood when we come out of the property. It was sort of like, yeah, they're all right. And I thought, yeah, they're all right. And I was waiting for the phone call, the email to say, Chris, no, we don't really like them. They're just standard buy to lets or whatever. And lo and behold, he said yes, as that man from Del Monte used
Yeah.
to say. And that was it. That
And
was the start of it.
I'll be honest, obviously the property stood their own test, but he had got into bed with people that things didn't work out well. And
Yeah.
that's why if you think, and there's a couple of things in here for anyone who's listening and starting out. I just turned up every week. No, you'll give me stick for not turning up now, but I used to turn up every month, dress smartly, if I got the chance to talk out loud or for people to get to know me, I would have done it. And I just made myself, I always think I just made myself a viable business partner so that when you and Mary were talking about me, you were going, this Paul McCoubrey knows what he's doing. And I just done that and then opportunities open. So I often say back then when I was starting out and younger, more time, just you never know, just go to a meeting, just, show up.
Well,
And
I
then,
think you hit. Sorry to jump. You hit the nail on the head there. It was consistency. It's what a lot of people
yeah,
don't do, and I see that people come to property meet for 2 or 3 months and then they stop coming, and something else gets in the way, and maybe a couple of years later they come back, and it's almost like, oh yeah, I'm back in. I'm starting again, and you think, how far would you have been if you'd have stayed and kept coming month after month and being a
I
bit
just
persistent?
learned, yeah, make
Yeah,
friends, network. That whole thing about your net worth is your network's your net worth. But
yeah,
Chris, that's the same as lots of things in life, health and fitness. Just one wee bump on the road puts people off. So yeah,
yeah.
no, it was a great decision. Obviously, we have now became really good friends, business partners, bought houses, sold houses. I think we've done every strategy that's out there, and now we're sitting with a much more profitable portfolio. And again, that was delivered for us through just
Yeah,
having business meetings, so to speak, as to where we want to go, what do we want to do. But again, I think
yeah.
back, it's who you partner with. Every agreement we have, I have on file as an email saying this is what we discussed, this is what you said you're going to do, this is what I said I was going to do. And if that changes, then someone needs to bring it to the table, and that's the way we've worked, and it's been good.
Yeah, I mean, you said there that we've done different strategies, and we started off. I suppose the strategy was buy to let, but it was kind of money in, money out. Always tried to add a bit of value to something, refinance it, get the money out, and go again. And I think maybe we had 7, 8, 9 properties at one time. And as you say, we've scaled back, rather than a couple of £100 here and there. We've scaled back and got a better portfolio, smaller portfolio, but a better portfolio with better cash flow coming out of it, which is great. That's the way you want to go. But Paul, I want to jump back. This is in recent years, in the last 10 years. I want to jump back to the start of your career. Like, how did you get into financial services? What made you get into financial services? Is it something that you always wanted to do, or did you just sort of decide when you left school, or when did things happen for you?
If you'd have knew me at school, Chris, no. I was lucky. I went to Inst, Centre of Belfast, and Templeton Robinson Estate. I never wanted to go to university. I knew it would have been a waste of time. And Templeton Robinson Estate Agents, we took an ex-Instonian on as an office, ferry office junior, and I got that job. And I, again, luck, sat beside their mortgage advisor, stroke financial advisor, and he and I got on really well. I haven't seen him for years because I'd love to thank him, but he basically took me under his wing and I said, "How do you do what you do?" He says, "Well, you just need to go and do these exams. You can do them at night school back then." And off I went and done them. And then I just worked my way up my career and I worked in Prudential for a couple of years. And then I worked, my big move was to Northern Bank as a trainee financial advisor, which was hard to get such a good trainee package. But I got in and I was 22. So I fell into it, but fell into, I felt like I didn't study much at school. I've studied more since I've left school, but it's a people, financial services is a people business. And it's
Yeah.
about, having, looking after people, being able to communicate, which I find a lot of young ones, especially these days, struggle with. Being able to sell, did a couple of sales jobs, like working in Argos and things like I could always, even at school, I could always talk my way into trouble and back out of it. And it just led me down the path. Now the biggest change came was I always knew I wanted to go out to work for myself.
Yeah.
Never did I think I'd be running a business, two businesses with 18 people involved and turning over like over 2 million last year. Um, that'll I left to basically be a self-employed advisor in 2006, 26 years of age. Mortgage market, they were giving mortgages out in the back of cornflakes boxes back then, if you remember, before the crash. And then I've just worked my way through that again. And I love the business side. I've always loved the business side. A lot of
Yeah.
my family influences are self-employed, who come back to my granda. It is later days, and it's just I always wanted to have my own business because I always felt that was the way you could make, you could really make good money and have everything in your own control.
Just when you mentioned money there, and obviously financial services, it's all about money, wealth, whatever you want to call it. You were talking to other people about their money, or that was the plan. That was what you were trying to get into, doing exams, etc. Whether it was to be a mortgage advisor, financial advisor, whatever. Your attitude to money, being a financial advisor, my attitude to money back in the day was it's for spending. I had no plans to save it. I had no plans to invest it. It was, I was young, and it was just go out, have a few beers at the weekend, try and have what I thought was a great lifestyle, and I had no money at the end of the week or the end of the month, whatever you want to say. What was your attitude to money like back in those days?
Well, you know me now, and I'd like to do all those things. However, I've I I have a financial plan, and I'm funding that financial plan out of monthly income. So anything over and above that, you can go and enjoy it. I get Chris. I got lucky again. My dad's a big influence in my life in that he had went through a hard time when divorcing my mum when I was younger, and money was incredible. Like he was in debt, and he worked himself out of it through personal development, rich dad, poor dad, educations, and as the oldest son imposed sort of imparted that on me. But then I fall into like Prudential and the Northern Bank, where you see the horror stories. So I often say like I borrowed silly money or did silly things in the early 20s, and I I quickly got that out of my system. You know, so by the time I'm
Yeah,
23, 24, I am starting to save and I've bought my first house and I'm starting to do these things. And then because I'm a financial advisor, I'm interested in it. Um, and then it's just sort of grown from there as you go along in your career, you earn more money. And then within our business, within Navigate, financial advice changed about 10, 11 years ago. I went to me and you've talked about this. I went to a conference. And then when you just go to a conference and something shifts in your mind, you just see a new world. You open a door that you didn't realize there was a world behind it. And the world for us was the modern day financial planning where we use cash flow planning software. We're very tech led. Well, you're a client of Navigate. You experience it every year.
yeah,
It wasn't about investment funds and how investments were doing, and even though they're very important, but it was about yours and Mary's life and what you wanted that to look like in 10 and 20 years and how much money you were going to need to have, much assets were you going to need to have, and that was a game changer for me, which just switched me on to I actually sat and did my own financial plan and went, I need to tune in here because if I don't start putting more away, I won't have the life that I want later on.
And
So
what age was this at, Paul?
I was
Was this
10,
early on?
yeah, I was 10, 11 years ago. So it's probably early 33, 34.
Yeah,
And we call it lifestyle financial planning, but it's just the modern way of doing it. And that was, and then from then, you know, it's for me, it's been about really tuning into the assets. And assets to me is your own business, owning property, having then your ISAs and pensions invested in the stock market, and just going back to things like multiple streams of income and planning for tomorrow, but also enjoying today. It's like a lot of things in life. If you look at, I think of this about health and fitness. Like I'm healthier and fitter now than I was 10 years ago. That didn't happen. That's just continually consistency, turning up, doing the right things. Pretty boring and not exciting. But then after a while,
yeah,
the compound
good,
effect kicks in.
exactly. Yeah, good habits every day, and I mean the opposite applies too. A few bad habits every day starts to have a compound effect on you, where you start
Yeah.
going the opposite way. You know, I suppose back in those days when you started off in Templeton Robinson, you know, Northern Bank Stroke Danske, big learning curve. Did you make any mistakes back in those days that maybe you didn't realize they had a massive impact on you, like big learning curves?
Yeah, there's definitely, if there's been mistakes this week. I think you're always going to make mistakes, but it's trying to learn from it, isn't it? And probably back in the day, like, I think if we bring it back to property, I can't think of my own career. There was mistakes how I dealt with things, or
Mm,
rushing into things. All the mistakes someone young and hungry breaks. But even if you think about us in property, when we started out, like I was a mortgage advisor, and the first two lenders we used were not the lenders that were going to let us borrow more, and we had to go and change that and go back. Um, we bought maybe one or two properties that did they really make us money over that time when you look at inflation and you look at cash flow minus tax and things like that. But no
yeah.
mistakes, Chris, to date, touch wood, that have hurt me, but more along the line, more right, I can learn from them and just take them on from the next one. Um,
No,
but
what
like
what what would be your biggest lesson so far then?
in property or business
Yeah,
or
in property.
property for me, not having. When I think back to when you approached me about that deal, I was thinking about the here and now. I wasn't thinking about five, six, seven properties down the line. Now I can defend myself because I never thought that was going to be the case. I thought it was going to be a one-off deal and here we go. But if we had sat down and actually said we're going to do this, well then we would have used a different lender, for example. We
Yeah,
may not have bought those one or two houses and used up a wee bit of our money at the time. But isn't it just like that in business? You don't, when you start a business, you're just wanting to get through the first month, the first year. You just, all the books tell you to think long term, but in your head you just think that's a waste of time because you're in survival mode. So when I look back, I would love to have done a bit more, just thinking bigger.
yeah.
But at the same time, in the here and now, you're just trying to
So,
survive.
so, so back then it was you kind of thought, oh, this is going to be a quick in and out, maybe make a few quid and that'll be it. But I think your attitude changed then. It became a wee bit more long term thinking. And I suppose, together we weren't really sure what was going to happen at that time. I had a couple of properties. I'd put money into them, had to refinance. You came along, presented the deal. And I would have been the same. It was a kind of quick in and out, and all of a sudden we started to plan of where we're going to go next, what we're looking for, how it's going to work, so that we sort of started adopting a wee bit more of a long term thinking strategy on it. Is that what happened for you, or did it just happen by accident, or?
Yeah, yeah. Same as with, we're 12 years in business. You and I, touch wood, no arguments because we were clear from the outset what each other's rules were. Plus, we're both easy to talk to and deal with because, again, you run your own business, so you're dealing with lots of crap every single day. But yeah, I think with maturity and also belief and actually seeing things work, that you start to think, oh, right, where could this go? This has got legs. This can work. And it's the same in Navigate. Like we started out 11, 12 years ago. I remember sitting with Michael and we're, one or two staff. Never did you think it would grow the way it has grown. And again, that intentionality is probably only the last 6, 7 years. It certainly
Yeah.
wasn't. It certainly wasn't what I thought it would be at the start, which is great. And again, with maturity, you grow up. Becoming a father also helps give you more of a purpose for why you're wanting to do things. More money in the bank, more knowledge, more experience, more stakes, and then all of a sudden you go, right, look, we're onto something here. That's, why not think bigger and go for it?
Back in the day, because just touching on something you said earlier there, you didn't think you'd be able to invest in property because you didn't have the sums of money, and sort of quickly we worked around that. What was your attitude to the risk in property? Because I know a lot of people that are listening maybe haven't invested in property, and any kind of investment is risky, as we all know, because that's what it is. It's an investment. The higher the return, the greater the risk normally. What was your attitude to property back then, and has it changed over the years? And if so, what changed that attitude?
I don't think the risk has changed. Obviously, I grew up in a property family, so watched my dad through the noughties, build his property portfolio, but then obviously lose it. But the reasons not lose it, but deal with the crash. I was able very quickly to look at the mistakes of the crash because I had enough people. I was doing enough mortgages for landlords, etc., who overextended themselves, and then that's when the market fell 50%, they were left with massive negative equity, and just thankfully the interest rates reducing allowed people just to continue on. So I wasn't when you looked at those deals that we bought, you could see very clearly we were buying them for probably 25-30% below market value. They were in the center of Ballymena. I think the biggest surprise was how good the rents were in Ballymena, because coming from Bangor, I would never have, you know, I never thought that Ballymena was so strong. They weren't far off Belfast yields when you look at what we paid for them and what we were. I think what as time has gone on, I think today I don't think about the risk of if you're going to buy a property, you need to be keeping it long term, unless you're going to flip it. That's a different conversation. But it's a long term. I always knew it was long term. I looked at these as probably a pension when we bought them. Then the pension rules changed. I think today the risks, and I talk to a lot of people who want to get started in property, and I always say to them, look, if you're going to do it, get the first one done. You'll learn so much in the first one. You'll make all the mistakes in the first one, and then you'll have a proper feeling for them. And what I mean by that is, I remember Raymond Crooks, day before we finished for Christmas last year, putting a video on his business page saying that you needed to have electrical certificates. I text your Mary saying, what's this about? Mary says, yeah, you were meant to have them by last week or something. And getting them organised, a bit more work needs done, ends up 2 properties, cost me the guts of $1,000. And I'm like, so for me, when I think of risk of property today, you have to just understand that things come with it. Also, when me and you were doing them, the cost of materials was much cheaper. The stamp duty was much cheaper. There was no Section 32. Yeah. Do you know where today, especially if you're trying to get in and get your money back out, it doesn't take much for that, because there's an extra cost, because the material costs are higher, the tradesmen are higher. And I think that's more of the risk today, is if you're tight and you're trying to get the deal done. But long-term investment, property still stands on its own 2 feet. And if that's the area you want to work in and you want to build on, then it's a fantastic asset. And because I'm a limited company director, majority of my money goes into a pension because the taxes just outweighs everything, the tax benefit. However, I keep properties because I like the diversification. And in 2022, my investment portfolio was down 25%, but my properties are going strong. And look, neither of them, it doesn't matter if it were down, it didn't matter if the properties were up, because I wasn't selling any of them. But here, something made me feel better.
Yeah, absolutely. Just jumping back there to what you said about the cost of materials and the cost of labor and all that stuff has just gone through the roof, especially since COVID. I was speaking to someone there the other day that I think they last done a refurb, and I might have done it for them back in 2014, 2014, early 2015. Rang me up, asked me did I still have the lad working for me, and I was like, no, he left in 2015. That's how I know that he hasn't done a refurb since. And he says, oh, this house needs everything. He says, I'm going to chuck about 15 grand at it. I'm like, 15 grand's not getting you much these days. if you're talking about a new kitchen, new bathroom, painting and decorating, that's probably it. Rewire, new heating system. It runs into thousands and thousands of pounds more than that. So yeah, property has changed over the years, but would you say that all the rules and regulations, has it knocked a few amateurs out of the market? Has it professionalized
Yeah.
things a wee bit more? What's your opinion on that?
Yeah, I think that property prices in Northern Ireland continue to rise due to the just severe shortage of properties that are out there, making the supply and demand, the demand outweighing it significantly, making it harder to find the deals. Like, we were finding deals at 25-30%. If you're starting out, then you need a mortgage. The property needs to be in some sort of good, decent repair. It's very different if you're getting in with cash. Then I think you have more opportunities of cash. But if you're starting out and you've got that limited resource of money to try and get this deal done and ultimately get your deposit back out to do the next, everything needs to go right. We're back 10 years ago. You could afford an unexpected boiler change, or do you know what I mean? And then also the cost of getting in now is horrific. With the government have just made it so difficult with high tax rates, stamp duty, and can only claim 20% of the mortgage interest. Like, what other business are you not allowed to claim interest and finance to grow your business?
Yeah, I think property is the only one. I'm thinking about my attitude to property when I first started investing, and the big thing was you said just get the first property. You'll make a few mistakes, and of course we did. Get the first property, and then you get the second property, and you think, whoa, I'm up and running here. And then it's the third, and then you set yourself a target. Oh, I want to get to 5, and then you want to get to 10. And I had this thing, and I know a lot of other people, it was just the number of properties. They wanted to be able to say they have 10 properties or 20 properties or 30, and even some people saying, oh yeah, I bought my 50th the other day. Now I sort of think, and we touched on it at the start, where we have sort of changed our portfolio to have a better portfolio, but a smaller portfolio. It's more easy to manage, but it cash flows more. Would you agree that sort of just adding assets to your portfolio is not necessarily the thing? It's what it does for you. It's the lifestyle it gives you. I suppose it's the outcomes we're looking for, more than anything else. Not just adding a house. I don't really care about houses. I care about the outcomes of houses and the lifestyle that houses can give me.
Yeah, for me, property's just a vehicle. It's not the strategy. And you've heard me have presented enough times at Property Meet that my message is property's only a tool to get you there. You've got to understand why you're doing it and what you want out of it. So I remember you phoning me one time years ago saying there was a deal on a property and it looked great on the front, but when we worked it back and worked in the tax for them, we went, this isn't going to make us anything. What are we doing? We were just adding another notch, another property. And to me, there's a few things. First off, financial planner, you need to have a financial plan written out, and a good financial planner will sit with you and talk to you what you want in life. And most people I meet in Property Meet want to use property as a vehicle to give them a better life, whether that's today getting out of their own job, or more likely as a pension in the future to provide you with an income in retirement. But if you don't sit down to work out what you need in the future, as I always talk about, what is your magic number? How much do you need to have the option of not having to work? Well, once you know that, then property falls into, for me, there are only 3 proper investments in the world. And an investment is categorized by 2 things. It will typically go up in value most years, and it will pay you an income most years. So property pays you an income, goes up most years. Your own business, if you work hard at it, the value of that business should go up every year, provide you with a wage. And then stocks and shares. Buy stocks and shares, you're buying the best companies in the world. They typically go up in value most years and they pay you a dividend. And they are your tools, then your vehicles to get you to that end point. Too many people do exactly what I did and just jumped in and thought I need to get as many properties as I can, everything will be fine. But you and I know it's not, because when you work them out, you take that example of the electrical certificates. It was 2 houses, so say it was 500 each. That's 500 straight off my profit straight away. And then the year before was carbon monoxide alarm, and then you get a tank. You've a tenant move out. You're spending a couple of grand to put that house back to to clean and tidy for the next tenant. So for me, I preach about actually before you dive in and go for it, is sit down and work it out what you really want. And I've had people come to me saying they want a property because they want to have more flexible living. And I'm like, but how does property give you flexible living? It only pays you a fixed rent. Uh, you can't put an ATM machine in the side of a house. So it's not always the only option. There are other options to get you there. And for me, when I think about clients who I deal with who I think are very successful, typically they're either high earning and don't spend anywhere near what they bring in. They have their own business, they have a few properties, and they're really investing in their ISAs and pensions. And they've got this all round portfolio that's all driven towards someday in the future having options and flexibility.
I'm going to put you on the spot here. You mentioned a few different investment types there. What would be your favorite? I know this is the Property Success Podcast, so you don't necessarily have to say property. Maybe I should
it's not.
I should rename it the Lifestyle Success Podcast because you know, as you said there, property is just a vehicle. You know, Mary says in her social media she loves everything about property, and I 100% agree, she does. But at the same time, property is just a vehicle, the same as the stock market, the same as business. They all need to be worked at, don't they?
Yeah, and look, that's why me and you let Mary look after our properties because she loves it that much. I wouldn't do this if I had to be hands-on, but that's because I see Navigate as being the bigger, you know, if I think of hourly rate and potential for the future, I think of Navigate. I like owning a few properties. You and I have obviously bought in the last year, but we've bought specific HMO, high yielding, long-term investing. But for month to month, ISA, pension, stock market, understand the stock market, understand that the volatility that comes with the stock market is not a worry or a concern. It's just a feature. And if you look at the compounding effect of that, plus the tax benefits, and as I always say, my pension isn't phoning me at 5 o'clock on a Friday to tell me that there's been a leak or a chimney tile blew off in the latest storm.
Right.
So yeah, no, for me, investing monthly, buying shares in the greatest companies in the world and just letting them do their thing. But that doesn't take away from, I've met plenty of people at Property Meet that doesn't matter what I say or what they just want to get into property, then go for it, do it. You have to live it and breathe it to really to understand.
Yeah, you talked about you know, what you do, lifestyle financial planning. If somebody was sitting down in front of you today and they're thinking about all those different strategies that you mentioned, what would be the first question you would ask them?
Why? Where are we going?
Why you want to do it?
Yeah.
Yeah.
What's the end game here? Because there has to be an end game because we're going into business and every business should have an end game to get out.
What's the most popular answer? You know, when you say
not working forever, I think.
Yeah.
Yeah. Do you think about, you know, when I ask you and Mary, what's the plan? You've got the time and energy now to keep working for another 5, 10 years.
That's debatable.
Yeah. You do have the time with the amount you achieve, but the point being, later in life, you won't have the same energy. So you want to have the money then, so that allows you to have options and to take a step back. And that's any client that comes into me first is why. What are we going for? What does life look like? And so many of them start talking, I have these pensions, I have this. Now, whoa, that's not, what are they doing for you? They're just vehicles to get you where you want to get to. And the most people you speak to don't want to work forever. They want to know they're going to be okay.
Would you say that most people, or maybe the minority of people come in, have actual goals?
No.
Or so you need to kind of tease it out of them, work with them to fully understand what it is they're wanting out of life. Which is strange because, you know, people, if you don't have any goals, like if you don't have targets, how are you going to know when you get there? Most people just seem to be ambling through life, and life is passing them by, and maybe they're not tuned in that they're missing opportunities, and you know, not going the right road, not going the right path, not speaking to the right people. I just find it strange that most people don't have goals.
Yeah, but I think what I've learned from, I'd have said that 5, 6 years ago, Chris, what I've learned from experience is life is just so busy and people are just caught. They're not able to, they don't have the time to come and do the helicopter view. You you have been in the personal development world for a long time now, so you understand the importance of it. And there's times where you're in this storm, but there are also times you're in a mastermind that you have to go to England for. That gives you time on a plane to just sit and reflect. And do you know what I mean? So people
Yeah,
don't think like that because they're in the here and now. And I often say, like, people come in for our annual planning meetings and they've done no prep. And I laugh because I see it as such an important meeting about planning for their future. But they come in for an hour with us. They have a good meeting. We tell them, yeah, you're on track, or we tell them, look, you're not on track, but you need to do X, Y, and Z. They then leave, and you know yourself, once they leave that 1 hour meeting, mobile phones back on, messages, kids, life, and it just becomes busy. So a good financial planner is near like a financial life coach, as we call it, lifestyle financial planning, but to allow people to take that step back and go, well, what is it that you want? Now, the majority of people want to be retired at a good age. They won't have a clue how much they need, so we help them do that. But they'll want to have their mortgage cleared by then. If they've kids, they'll want to have funds available to help the kid. And nowadays, helping the kids is not just university; it's house deposits and weddings, and the burden on parents is has just got bigger and bigger. Majority of people, that's it. And what I love about my job is when you actually start to tease other things out. So they may, I remember clients of mine saying that they'd love to go and do the Lions tour. I think it was the COVID one, the way it worked out, but they ended up going to Rugby World Cup. But the lady said to me, yeah, but it'll be about 15 grand. I knew straight away she could afford 15 grand, but she's never spent that amount of money before on a holiday or a trip. So I got her talking, saying, "Oh, just talking small chit chat about rugby." And on her cash flow plan, as she's talking to me, I type in expense 15,000 South Africa trip, and I was able to show her that it made absolutely no difference to how much money she'll have when she's 90. And I love
yeah,
that. And a lot, people camper vans, they want to have a camper van when they retire. And that's the bit that I enjoy the most about my job is the sort of retire, mortgage off, kids look after your kids is like the foundational stuff. But what is it? We have talked about this. You and Mary used to talk about living in Portrush. That changed. Place in Spain, that changed. Things change. But if you can eke out what people really want to do and what make them happy, then that's why I love my job because it's not money is actually, as we have said here, money's just a vehicle. It's about actually written down, pound specific, goal driven financial plan will change your life.
yeah. I would agree there. Just when you said about people not sort of fully understanding what it is that they want and how that fits in around their financial plan. The example being the £15,000 trip to the for the Lions tour or going to the Rugby World Cup. And there was some things that we had maybe floating around the back of our mind, giving Sophie a deposit for a house, but we never actually had anything written down to go, well, how much is that going to be? Where's it going to come from? And what's it going to look like in terms of our financial plan? Because it was just a thought we had in our head as something that we need to do. And I think sitting down with yourself and doing that lifestyle financial planning and looking at, where we are now, where we want to get to, all the things we want to do in between, the kind of lifestyle we have, how we're going to fund it, including say the £25,000 deposit for a house for Sophie. I just found it a huge benefit when I initially had thought that financial advice would be here's how much you need to stick into your pension. It was much, much more than that, which I found fascinating. Is that the kind of thing that most people think, or is it just me? Or
Yeah. I would put you into the category of you and Mary were always going to be okay. You were buying assets. At the end of the day, spend less than you earn, make that difference work for you, and yous were doing that, and yous would ultimately always be okay. I think I describe it as a sat nav. You haven't put an end point in, and not that financial planning has an end point because it changes, life changes all the time. But you hadn't put a flag in the sand and say this is what we would like our life to look like. This is what we're probably going to need. If we weren't earning a penny, this is what we're likely going to need, and work backwards a little bit. And then my job was just to sit down and get these streamlined. You weren't using pensions, which was, a very easy solution for someone who has limited company profits, and to get some money back off the government. The other thing that was interesting with you, and I always remember you saying that, is like whoever sat down with you with your property spreadsheet and went, right, what's this property doing? Where's it going? And you made a comment.
What?
We were talking about your future, and you were needing X amount of money in, and we were going, right, well, can we rely on these properties to bring half of that in, for example? And I remember you saying to me, the properties we'll have in the future probably haven't even been bought yet. And I always thought
The
that was,
good the good deals, yes,
yeah,
definitely.
because your strategy had changed. You'd had a lot of properties, but they were the small cash flow, and that long term,
Yeah.
were they going to go up that much more in value and stuff? And that's all because you just had I know we're friends, but you just had someone questioning you about being accountable, acting as a coach, not judging, and saying, right, what does this look like? Like, how long are you going to keep doing Property Success University? How long, and and we, you know, things will change. Different, like you've already started another business, and they're
Yeah.
involved with Ballymena, and your life has changed in that 3 4 years that we've been sitting down doing it. But it's the fact that you actually had someone ask you the question. It's like you've worked with business coaches. A good business coach will work out where you are today and then go, right, is this what you do today going to get you to where you want to be? Well, not
Would
enough
you?
people do it.
Yeah. When you're sitting down with people, would you look at what it is they want to achieve or what kind of lifestyle they want once you understand their why, and then advise them on what kind of investments they should make, or
Oh yeah, yeah.
how does it work? If somebody hasn't met you before and thinking about, I need a bit of financial advice, what does it look like? What do you say to people? Where do you direct them towards?
Yeah, so like first and foremost is we have a wee saying, no portfolio, no plan, no portfolio. What that means is if we don't know what your plan is, where you're going, then how can we recommend an investment portfolio for you? So we have to work out um what it is that you want to achieve. Then it's our job through our software and our tech to work out, well, how do you achieve it? And then finally, it's what is the investment product you need? Is it a nice pension, property? All of them helps you to do that. So first and foremost, there's an old school way of financial advice, which is the way you talked about, and then there's the way we talk about. And if anyone's going, it's not cheap to have a financial planner these days due to the regulation costs and everything that goes with running our business. But uh, paying for that initial plan to help you work out where you want to go is the first step. You might not need that financial planner every year. You might just need to get started by starting up some monthly investments, using the likes of Vanguard to, even if it's 100 quid a month, ISA pension, and you just need to get started. And I've helped quite a few people, especially in Property Success University, just get started. They don't need me every year. They don't, the amount they have at the minute wouldn't justify paying me a fee, but they've started and they've up and running, and the money's gone out every month. And it's amazing after a few years when you look at it, you go, flip, I wouldn't have had that if I hadn't just started.
Yeah. I was going to say, again, it's the Property Success Podcast. The majority of people that are listening to it are property investors. Do you think people need to invest in other things? I know you mentioned a few there, and you've probably already answered it, but is property enough, or do people need to be looking at
My
other?
opinion is that you have to diversify. Property is long term, but it's rigid because one of the mistakes of 2006, 7 was people borrowing against the value. You do not want to be doing that now. You want to be keeping a good loan to value. But property, you can't put an ATM in the side of property. So when it comes to, especially in the future, say you wanted to gift to your children, well, you can't just go and take part of that house and gift it to the children. You need to have liquid. Property will only pay you fixed rent. So it has its place, steady Eddie, long term, will pay an income. You know the value's in it, but you're going to have to liquidate that value. So an ISA, for example, 100, completely free of tax, of income tax, capital gains tax, can take money out at any stage, completely tax free. Great vehicle for big expenditure, gifting money, because more and more people we haven't touched on are being hit with inheritance tax liabilities now than ever before. And then your pension. So what other investment if you put £100 a month into will give you £250 back straight away, guaranteed. 25% tax free. If you're a higher rate taxpayer, you'll get that again in your tax return. If you're a limited company owner, as you are, Chris, when pension goes out day one, no corporation tax. massive savings. So they've all got a part to play in your overall in what you're trying to achieve. What I'm finding now with the longer term landlords who are probably hitting 60, 65, they don't want the property, they want to liquidate, is that they're being able, they can sell the houses because the property, the market's so good. They can sell the houses, give us the money, and then we invest that to pay them the income. So the rent is still coming in as such, but they've got flexibility. And if you factor in inheritance tax now, then we're talking to people in their 50s about inheritance tax liabilities. I was never doing that before. But the regime that we live under now in the UK and the tax system is more and more people are getting caught in the loop. And property is not great for gifting. And, people say to me, I'll gift the property to the kids. I'm like, don't gift the property to the kids. If they're in their 30s and 40s, they need the cash. They want to pay their mortgages off. They want to help their kids, whatever. Does that answer that question?
It does. It does. I mean, the way I look on it is, like property, pensions, business, stocks and shares, whatever. They're just really tools, aren't they?
That's
And
all. They're just vehicles to help
depends,
you get from
depends
A
what
to
you
B.
want.
Yeah. And look, it's sat nav, where you are today, where you want to get to. If you want to get there quickly, then you're going to need a Ferrari, but you're at risk of that going off the road or not being able to handle it. But if you want to get there safely and get there in time, you build. It's the whole, I go back to personal training a lot. It's consistency beats intensity. It's about having the habits. It's about investing every month, living below your means, buying assets and just working on it. And also the big thing when I think about this now, I chat to people, get bloody started. How many people do we see at property meet to talk and talk and talk, and then they're wanting everything to be a guaranteed outcome, which it's just not possible. You have to take the risk.
Yeah. Yeah, I mean, we said earlier on, sometimes the higher the risk, the greater the return. So, if you've got an attitude to risk and it's not great, well, then stick with smaller returns and then just, try and grow a bit of confidence around your attitude to
Yeah.
risk. And who knows, things will change.
And I'm
What's
not
your
saying
attitude?
there, sorry, I'm not saying that you don't try to cover as many bases as you can. Of course, you do your due diligence, you do your homework, but you meet people who just want the I's dotted and the T's crossed, and that's not the way life works when it comes to investing in anything.
Yeah, and opportunities pass them by because of that.
Yeah, people
I mean,
say, when's the best time to invest? It's like planting
today.
a tree 20 years ago or today.
Yeah, yeah. Just get started. What's your attitude to risk, Paul? I know you advise other people, but what's your attitude to
It,
risk?
it depends what you deem by risk. All my investments are 100% stocks and shares that go up and down every single day, but I don't look at them. I'm confident in where they are. But I would probably say, like, I'm not a you said it earlier. I will think things through, and I'm actually saying it about people doing this there just a minute ago. But I do think things through. But then once I get over a line, I then put the foot down and make things happen. So I would say I'm more attitude to risk. I obviously take risks. I have my own business. I invest, but I don't invest in Bitcoin or I don't. I've often thought about putting maybe 5% of what I have into it because I believe there's something in the currency digital currency.
Yeah,
I just never get around to it. So I'm not against it, but I'm not a big risk taker. I like security. I think my upbringing, my father not having money, and I saw the effect of that when I'm 11, 12, 13. Having money, I like having money in the bank to look at. Do you know what I mean? So I wouldn't
yeah,
go. And as I get older, and I struggled with this in the last year, as I get older and my businesses are getting bigger and stuff, I probably worry a bit. What about if something happens? Because I've watched my dad go through the property crash and I've watched other people have the rug pulled from beneath them for things that they could never have foreseen. And that sometimes worries me a bit. So I do like having money in the bank because if you've got money in the bank, it reduces a lot of the risks. But it's a long
um,
term. That's like thinking about people listening to this, this is a long term game. And even if you're 40 today, you have 20 years of good work, good saving, good investment, compound interest will make a difference. I say to the young one, I feel old in my place now. I say to the young ones in the 30, you don't realize, they're saving, they're doing the right things. Because you don't realize by the time you're at my age how comfortable you'll be. And they sort of look at you, all right, old man. But it's so true, isn't it?
yeah. Yeah, no, absolutely. Listen, life passes you by very, very quickly. Property Meet's been going 15 years. Coming up this year, Property Meet's been going 15 years. So when I started it, I had maybe just turned 40, and a lot of things that I wasn't thinking about. A lot of things that I'm now thinking about. 15 years goes past very, very quickly. It goes in the blink of an eye. And at the same time, buying property, I'm waiting 15 years, or putting money into a pension and waiting 15 years, or buying stocks and shares and waiting 15 years. You're going to benefit over the longer term without a shadow of a doubt.
Yeah, but people don't want that, Chris. People want
Yeah, quick.
people wants to. Yeah, look, I think if anyone wants a book to read, Morgan Housel's Psychology of Money, fantastic, fantastic book, talks about all of this, and people just continue to make the same mistakes as they've always. Second book's called Same as Ever, which is basically saying people are doing the same things that was 10, 20, 30 years. It's just human. But yeah, the time thing's good. I think it's also just the caveat that, and you and I have lived this, is it does go quick. So life's for living. And I have quite a few clients that can be surprised at me. And one client texted me recently saying, why after I'm in with you do I always want to spend money? And that to me is just, I'm doing my job right. So it's the balance. You've got to plant the seeds for down the line, but you got to enjoy it. Experiences and memories.
Yeah. Yeah, outcomes, as you say, which is a strange thing to hear a financial advisor saying, because typically people think financial advisors are, you must save money, you must invest money. But here you are telling people to spend money and I 100% agree with that from, our first meeting. Like, what is it that you want? What kind of lifestyle do you want to have? And people get used to saving and investing and not actually reaping the rewards of what it is they're doing. They don't have the lifestyle that backs up the investments they're making, and you think, well, why are you doing it? Obviously, there is. I mean, it's maybe we don't know what their why is, but if people are going to keep investing, keep saving, never go anywhere, never do anything, what is the point of it? And I agree. I think people need to look after themselves, be good to themselves, be kind to themselves, treat themselves, and spend a bit of bloody money. That's what it's there for.
Well, we could have a full podcast on that, but if you just take it for now, that so much of this is in the head, it's psychology. It's typically like, if you've heard me talk about my father and his influence on me, we're typically influenced by our parents. And that's why you will find, especially people around their, young people don't have a problem spending money, but people in their 60s do. That's the influence of their parents and what they live through. And they've worked really hard. So I go for walks with my own dad at the weekends, and he often says it's a real struggle when you've worked all your life to build, build, build. And then you're telling me to spend, spend, spend. It's a massive chip. So a big part of my job is coaching and saying to people, look, you have enough. Look, that 15 grand trip to the Lions tour means you're going to be less X amount of money when you're 95. Like, do you give to, at 95? Or do you want to go and live it today? So it's all just about balance. And again, by working with a proper financial planner, you could say to me, Paul, me and Mary want to do a round the world cruise, 50 grand. I can plug it in and say, well, if you do that now, you're going to maybe have to work an extra year. How do you feel? I flip, I could do that. It'll be worth it today. Boom. You're in control. You've made the decision. You know there's a consequence later on down the line, but you don't give a shit.
Yeah, and people look upon a 50 grand spend as being, a complete and utter disaster. Couldn't afford that. But when you start to look at the bigger picture and put it in different terms, to work an extra year to go on the trip of an absolute lifetime, it's a no-brainer.
And if you enjoy your work.
Yeah, if that's not what you're saving up the money for, what are you saving up the money for? What do you call the girl, the Australian girl, Bronnie Ware, who said about looking after the people in a hospice and the regrets they had that they hadn't travelled more, they hadn't loved more, they hadn't spent more time with loved ones, all those things that people should actually do, but don't, because they're too busy trying to look towards some date in the future. By which point it's bloody too late. And most people end up with regret. And for me, as I'm approaching, I was going to say the twilight years of my life, but not quite. I'm sort of thinking more and more of what do I want my life to look like? Because I sort of think I'm working too much, and I should be maybe enjoying life a wee bit more, but at the same time having a better work-life balance. And I think people find that difficult to do.
Yep, it's balance and trying to work it out. Good financial planner will help you to do that and to try and find that balance where you're comfortable spending, but you know you're okay. And that's what people want to know. Am I okay? That's the question that we're answering 99% of the time.
I mean, for me, it's the sort of payoff. What am I getting out of this? And again, just I know I'm harping on about people doing this thing, this investment, this uh, working hard, and getting to a point later in life where they think, Jesus, life has just passed me by, and I haven't actually reaped the rewards. And then you just end up full of regret. But
Exactly.
Yeah, Paul, I'm not sure how long have we been on, about an hour.
Mm.
I suppose it's time to sort of wrap up. Um, have you any advice you would give people? Is there anything I've missed, by the way? Is there anything I should have asked you
No,
that I haven't asked you?
no,
You're
I think
probably
we've
going through
covered.
all sorts of things.
No, well, depends where we want to go. But I think today that for me, if I think back to what we've talked about, is property is still a good investment, can still work. I think looking at monthly savings, ISA pension, having building those assets up as well just gives you more options later on down the line. One thing I would like to say, Chris, if anyone actually gets to the end of this hour and they're employed and they're in a workplace pension, one of the things that someone can do that will make a massive difference to the tune of thousands, if not tens of thousands of pounds, is make sure that their workplace pension is invested properly. A lot of workplace pensions default to a middle of the road balanced portfolio, 60% stock shares, 40% bonds. Someone young with 10 years or more out from retirement wants to ensure that that money is invested in stocks and shares and that money is working hard as possible for them, and that they understand that when the market goes down, it's just a feature, it's not a bug, it's the price you pay to be for the long-term rewards. And that's something that I you probably heard me at property meet say that out loud. But no, I think there's two things: is if you're this is you in the beginning of your journey, then get started. There's lots of great online resources out there that will help you get started. If you at some stage of paying for a financial advisor to do your financial plan, it's not cheap. Ours start at £2,000. There are some out there that are a bit cheaper, but there's a lot you can do before you get to that stage. And then once you start building up, having a financial advisor, that fee will be covered tenfold because of the
Yeah.
advice you get. And I think
I,
also,
I, Sorry, I was just going to say, I was just going to back that up. I know you said there that maybe people think they can't afford financial advice, but certainly I think they should practice some of the things that you've said,
yeah,
because at some point, if you do these wee things month after month, year after year, and you're in your early 20s, by the time you're in your early 30s, you've built up a bit of a nest egg or an investment pot or whatever it happens to be, then it might be time to come to a financial planner and try and look at the bigger picture thinking. But on that
yeah.
point, I'm just jumping back to the beginning. Where if people are wanting to build wealth, what's the first thing you would advise them to do?
Yes, if you're on your journey, obviously anyone from property meet, feel free to give me a call. Just look up Navigate Belfast, you'll get our details. But I often say to young ones, and I've done presentation to young ones, there's great resources out there. One of them is a friend of mine called Pete Matthews runs a brilliant channel called Meaningful Money. He then has a university. So if you think, I often say that it should be your goal to have a financial advisor at some stage, as long as the fees are justified. And typically, those fees aren't justified till you go over probably 100 grand of invested money. So before that, like some Meaningful Money then has a university, very like property PSU, Property Success University, where Pete coaches you through all these basics, gets you set up, gets you started. Then, as you build, you start to work with a financial advisor, probably needing a financial advisor in around the age 40 to 45. And then that's at that stage, a good financial planner, their fee and the value they deliver will outweigh the fee. Otherwise, it wouldn't be worth it. And again, just get started. For those out there who have a financial advisor, we are in Northern Ireland, there are lots of financial advisors retiring. The average age apparently is 57. We offer a second opinion service, which is no pressure, no sales, just to have a look at what you have, make sure it fits in. So I'll give you an example. Yesterday, a couple came in. Mr. had a financial advisor, and Mrs. had a separate one. Now, how are you building a financial life together if you have two financial advisors? Now, the truth is, they just started with someone years ago. They don't do modern lifestyle financial planning. So at least they'd started, at least they had investments. Those investments have done reasonably well. But now at the age of 43, they want a proper plan together.
Yeah.
And the funny thing was, she's higher rate taxpayer, he's a basic rate taxpayer. Straight away, there'll be tax savings in that household through just doing this together. So free second opinion service, again, get in touch. But and then
What do you
the
reckon?
book.
Sorry, you mentioned £100,000 there as a sort of point where maybe it makes it worthwhile getting proper financial lifestyle planning. How long would it take? You say you're starting in your early 20s. What would you need to be putting away or investing to be getting to 100 grand?
Oh, that's too hard a question. I need to work that out for you.
You'd need a calculator.
Yeah,
Is it,
I think if you're starting in your 20s, Chris, you're likely a couple of £100 a month. So it's going to take a while. It might take 10 years depending on your investment growth, but it's very achievable. Those 10 years will come and go very, very quickly. And what I will caveat that with, we say 100 grand, just because otherwise, when a good financial advisor in the fees, if you don't have that, then it's not proper. It's too much out of your investment to be paying the advisor. You don't need it at that stage. But when you start to get in, so I have clients who didn't have 100 grand to begin with, but they're business owners, they're earning good money, they're maybe putting £2,000, £5,000 a month away, that we work with them in the early stages. We charge less a fee, and we work with them in the early stages to help them to build. So it depends on your circumstances. But if you're working in if £100 a month, £200 a month, you certainly don't need a financial advisor. You just need a bit of guidance.
And just finally, Paul, as someone starting off today and they're thinking, like most people when they're younger, I'm not very good with money, because most of us have the wrong attitude to money, and it's sort of drilled into us from the things we pick up. What would you be advising them to do? If they want to build a bit of wealth over the long term, what's the first thing you would advise them to do?
Keep going back to the health and fitness. It's where are you today? What's coming in, what's going out, sitting with the spreadsheet, working that out. And then hopefully you have a bit of a surplus there that you can then start investing. Simple stocks and shares, ISA, start investing. But it's long term, it's consistency over intensity. It's about setting the habits, as we've talked already. I often think, well, not often think, we should have been taught this in school. I see personal finance as a life. So you do Property Success University. I've often thought about doing the very same thing, but with money, because no one's teaching us, and we should know it as a life skill. So invest a bit of time reading good books, joining the likes of Meaningful Money Academy to just learn and to get your head around it. And once you get your head around it and you start to see it work because you're putting money in every month, it'll make a difference. And that's, to me, would be the start.
And this is a tip from me, just when you talk about books. I was going to mention it earlier. You mentioned the psychology of money, and I would recommend that people not only read a book, but study the book. And a friend of mine, what he would do with a book is he would take like a highlighter pen, let's say it's an orange highlighter pen, and he'd go through the book and mark off key points, things that he wants to remember. And then he would actually read the book maybe a year, 2 years later, go through it with another highlighter pen, a different color. So he's got all these books that he's gone through and highlighted, and he picks things out of them, because each time he reads a book, he learns something new about the book, from the book, that he maybe didn't pick up the first time around. So study the book, not just read it.
Well, yeah, they say instead of reading every book, you should pick your top 10, 20, 30 and just read and read and read. We tipped for me, because I was very guilty of reading plenty of books and highlighting and making notes and taking absolutely nothing from them because they just moved on. So I have started to take the highlights, and then I've started to use the ChatGPT app, and I'm going into ChatGPT and said, I'm reading next book. I'm going to now just dictate my lessons, my learnings, and ChatGPT, then you can ask ChatGPT to formulate that into bullet points, action points, and that's what I've done the last 2 books. And I'm trying to say to myself, can I take 1, 2, 3 max things from this book and apply it? Because we read so much and we don't apply. So I find ChatGPT give me a bit more of a structure because I just never bothered to go back and read it and do it, where the last couple of books this has helped. So yeah, great. Thanks, Chris, for the invite again.
No problem. You're very welcome. So just for people listening, Paul, how can people find you, get in touch with you, speak to you, book an appointment with you?
NavigateIFA.com or Navigate Belfast, that we will come up, and then LinkedIn.
Thank you very much for that, mate. Thank you very much. I'll put the stuff on the screen so people will have it. They'll not have to go searching for it. I'll put the contact details on the screen when I'm
thanks, Chris.
Podcast. Listen, thanks, mate.
All right.